Hello everybody, welcome to the 27th episode of me learning how to trade using Forex. So in the last episode we went through the Fibonacci theory lesson in the advanced technical analysis course on the official forex.com, and now we're doing the ABCD pattern lesson. So yeah, let's get started. ABCD pattern. Fibonacci ratios aren't just useful for identifying support and resistance levels. They also form the basis of some key chart patterns, including the ABCD. What is the ABCD pattern? The ABCD pattern is a visual geometric chart pattern comprised of 3 consecutive price swings. So, as a visual geometrical comprised of 3 consecutive price. It looks like a diagonal lightning bolt and can indicate an upcoming trading opportunity. Looks like a diagonal lightning bolt and can indicate an upcoming opportunity. This is a valuable pattern to know as it reflects the rhythmic style in which the market moves. Essentially, it is made up of 4 significant highs and lows on the chart. Highs and lows on the chart, which is a new prevailing trend forms at A. The market retraces at B. The initial trend resumes at C. You can trade the next correction at D. So this can appear in both a buy form and a sell form across any market, including Forex, stocks and more, any condition, range bound uptrends or downtrends, and any time frame. Can appear in both a buy form and sell form across any market, any condition, so range bound, uptrend, down trend, and any time frame. ABC sell pattern. So A, the new prevailing trend forms at A, the market retraces at B, initial trend resumes at C, you can trade the next correction at D. Often a market's movement simply repeats the ABCD pattern over time. A, B, C, A, well, this is a line A, B, C, D, A, B, C, D, A, B, C, D, A, B, C, D, A, B, C, D. In this example, you might notice that some of the patterns converge. This provides a stronger trading signal than a single AB pattern in isolation. Finding the ABCD pattern. To find the ABCD pattern, traders look for the legs or the moves between points. AB and CD denote the moves in the direction of the overall trend, while BC is a retracement. Look for the legs or the moves between points. AB and CD denote the moves in the direction of the overall trend. AB and CD denote the moves in the direction of the overall trend. While BC is a retracement. Each leg typically lasts between 3 and 13 bars. If you found an ABCD with legs that last longer than 13 bars, you might want to move to a larger time frame and check for the trend Fibonacci convergence. Between 3 and 13 bars. If you found an ABCD with legs that last longer than 13 bars, if ABCD lasts longer than 13 bars, you might want to move to a larger time frame. Could move to a larger time frame and check for trends for Fibonacci convergence. Fibonacci convergence. If you think you've spotted an ABCD, the next step is to use Fibonacci ratios to check that it is valid. This also helps identify where the pattern may complete and where to open your position. To verify ABCD, use Fibonacci ratios to check that it is valid. Take a screenshot of that. Picture format 49.99. So the Fibonacci, which is the little lessons we learned last time, BC is 61.8 or 78.6% of AB. BC, so is 61.8 or 78.6 of AB. CD is 126.2 or 161% of BC. In a classic ABCD, the BC line should be 61.8% or 78.6% of AB. So if you use your Fibonacci retracement tool on the initial move from A to B, BC should end at 61.8 or 78.6 level. Other ratios: in strongly trending markets, BC may only be 38.2% or 50% of AB. CD should then be 127.2% or 161.8%. Wait, that's why it says 127.2. Why does that say 126.2? Guessing it's another typo there. On a bearish ABCD, you might choose to enter a sell position at this point, or bullish one if you want to, or on a bullish one you might want to buy the market. The ABCD extension. Sometimes you might spot an ABCD extension. In this pattern, CD is 127.2% or 161.8% larger than AB instead of BC. Okay, so time of CD is 127.2 or 161.8% longer than AB. So that line should be 127.2 or 161.8% larger than that line. ABCD pattern rules. There are a few other rules to follow when finding ABCDs. Firstly, ideally you want the time and length of AB and CD to be roughly equal, unless you have found an ABCD extension. Ideally want the time and length of AB and CD to be roughly equal, unless you have found an ABCD extension. AB is equal CD. AB, that length there should be that length there, or roughly about the same. Additionally, in the move from A to B, the market should not go beyond either A or B. In the move from A to B, the market should not go beyond either A or B. In the move from B to C, the market should not go beyond either B or C. Time of AB equals time of CD. That should be F, shouldn't it? Not a D. Length odd AB was. In the move from C to D, the market should not go beyond either C or D. So it shouldn't exceed that point. In a bullish ABCD, point C must be lower than A and D. Oh, this is a bearish one, so in a bearish one, C must be higher than A and D, and must be higher than B. Oh no, C must be higher than A. Oh, this is a bullish one. Wait, point C must be lower than A and D must be lower than B. Right, so in the move the market shouldn't go beyond either A or B in the move from A to B. The market shouldn't go beyond either B or C in the move from B to C, and the market shouldn't go beyond either C or D in the move from C to D. In a point C must be lower than A and D. Point C must be lower than A, and point D must be lower than B in a bullish ABCD. Point C must be higher than A, and D must be higher than B in a bearish ABCD. Trading with ABCD. To find an ABCD on Forex.com account, follow these 6 steps. Log into your Forex.com account and open the market's charts. Find AB. Remember that this move must be entirely contained within A and B. Find BC. This retracement should reach 61.8% or 78.6% of the move from A to B. Draw CD. Using the AB and BC lines, you should be able to predict where point D will land. CD will usually be equal to AB's and 127.8% or 161.8% of BC in both price and time. Watch for price gaps and wide-ranging bars in the CD leg. These can indicate that an extension is forming, so CD should be longer than AB. Trade the potential retracement at D. Open a sell position if you found a bearish ABCD, or buy if you found a bullish one. ABCD fact sheet type pattern used in any conditions, used for finding opportunities, markets any, time frames any. Gartley pattern. Let's take a look at another pattern based on Fibonacci ratios. The bearish or bullish Gartley pattern is a useful one to know, offering insight of potential upcoming continuations. What is a Gartley pattern? The Gartley pattern is a bullish or bearish ABCD pattern, consists of 4 consecutive price moves. So, Gartley pattern is a bullish or bearish ABCD pattern consisting of 4 consecutive price moves. When you spot a Gartley, it is usually a sign that a prevailing trend is about to continue. It's a sign that the prevailing trend is about to continue. Like the 3 dive, the Gartley pattern is a type of ABCD with an extra leg. Gartley pattern is a type of ABCD with an extra leg. However, with a Gartley, the additional move comes in the form of a significant high or low before point A, usually referred to as point X. However, a Gartley comes from a point from a significant. This additional move comes from a significant high or this additional move comes from a significant high or low. This additional move comes from before point A. This additional move comes from a significant high or low before point A, usually referred to as point X. Usually refer to as point X. Right. This move from X to A is the prevailing trend. This move from X to A is a prevailing trend, which should continue when a Gartley completes. This move from X to A is a prevailing trend. So, this move from X to A is the prevailing trend, which should continue when a Gartley completes. Which should continue when a Gartley completes. So bullish Gartley, bearish Gartley, point X, that's the significant high or low. In this case it's a high, I think, so it rises up, down, and then this is your normal ABCD pattern. And so this shows that whatever happens after point D is pretty much whatever happens leading from X to A. So since this is an upward trend, then that's going to go up as well. Since it's downward, this is going to go down as well. So let's take a screenshot of that. Here to here, boom, copy, boom, 49.99, boom, boom, boom. Right, okay. The pattern gets its name from an early technical trader called H.M. Gartley, who first introduced it in his book Profits in the Stock Market. Gartleys don't only appear in stock charts though, you can spot them on almost any market. Finding Gartley patterns. To find a Gartley, you need to look for an initial trend that retraces in an ABCD pattern. So to find Gartley, look for an initial trend that retraces in an ABCD pattern. In a bullish Gartley, the significant move is from X up to A, reverses at B, resumes at BC, reverses at AB, resumes at BC, and then reverses again at CD. Bearish Gartley is the opposite, a significant move from X down to A. Retraces in an ABCD pattern. Right, so in bullish Gartley, the significant move is from X up to A. Reverses at AB, resumes at BC, then reverses again at CD. Bearish Gartleys are the opposite. In bearish Gartley, the significant move is from X down to A, reverses AB, resumes at BC, and then retraces once more. Down to A, X down to A, then reverses AB. At AB, resumes at BC, then reverses again at CD. Tip: bearish Gartleys look on an M, while bullish ones look like a W. So M, W. What was it? Bearish Gartleys look like an M, bear, 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 bear. And a bullish Gartley. Let's go W, wasn't it? Bullish W. In the bearish Gartley, M. Like the other ABCD patterns we've looked at, you can confirm a Gartley by checking that the legs align with the Fibonacci ratios. The entire move from A to D should be at 61.8 or 78.6% retracement of the original run from X to A. A to D. B to C should be 61.8% or 78.6% retracement of AB. C to D, CD should be 127.2% or 161.8% of AB. So this is the W here. You will also want to look for symmetry when confirming the Gartley pattern. Ideally, the time between X and A will be equal to the time between A and D. A and D. So that should be the same as that, I'm guessing. Copy that. So time down, time up. Oh, so that should be the same as that. Alternatively, the time period covered by the ABCD pattern should be a Fibonacci ratio of XA. That's a lot of Fibonacci ratios. Gartleys can be harder to spot than 3 drives, but they are also much more common. Right, okay. Trading the Gartley pattern. A Gartley is usually a sign that the original trend from X to A is about to resume. When the pattern completes, the market should reverse once more at D, making the end of the retracement. Time down equals time up. Also, that time should equal whatever that takes. I think this is more helpful than the other one, to be honest. Still, take this. Copy it. Paste it. Cool. In the bearish Gartley, you can trade this move by opening a sell position at D. If the pattern is bullish, open a buy position. So you can see that after that bit, then this goes down, which is the same as X to A. Okay, Gartley fact sheet. Type as a pattern used in any conditions, used for finding opportunities, markets any, time frames any. Three drive pattern. If you see an ABCD that forms another retracement leg instead of reversing, then you could have a three drive pattern on your hands. What is a three drive? A three drive is a rare price pattern formed by three consecutive symmetrical drives up or down. So, by three consecutive drives up or down. In its bullish form, the market is making three identical final drives to bottom before an uptrend forms. In the bearish three drive, it is peaking before the bears take over. 1, 2, 3 before it goes up. 1, 2, 3. A three drive contains two overlapping ABCD patterns. So that's 1 and that's 2. A three drive contains two overlapping ABCD patterns. If you can spot an ABCD, then you should find it easy to spot. Then you should find it easy to spot a three drive too. That's an ABCD. That's also an ABCD. Whilst they don't appear often, three drives can signal high chance of an impending market reversal. The resulting trade tends to have a very strong risk-reward ratio, so the pattern is prized by technical traders. So let me put this one in as well. Whilst they don't appear often, but can signal a high chance of an impending market reversal. The resulting trade tends to have a very strong risk-reward ratio. Tends to have a strong risk-reward ratio. Finding the three drive pattern. To find a three drive, simply look for an ABCD with an extra leg. It might be useful to think of it as an ABCDEF pattern. So to find three drive pattern, look for an A, B, C, D, E, F pattern. It's important, however, to take extra care when hunting for three drives. Ideally, the pattern should be immediately clear. If it isn't, then you might not have found a three drive. Much like an A, B, C, D, you confirm a three drive pattern using Fibonacci ratios. Much like an A, B, C, D, you confirm a three drive pattern using Fibonacci ratios. Confirm three drive using Fibonacci pattern. Pattern should be immediately clear. Confirm three drive pattern using Fibonacci ratios. Much like an A, B, C, D, you confirm using it. Yep, the drives at C, D, and E, F should be 127.2% and 161.8% extensions of the B, C, and D, E retracements. The B, C, and D retracement should usually be 61.8% or 78.6% of the previous drive. Okay. Symmetry is also key to a three drive. The elapsed times of the retracement and drives should be symmetrical. If they aren't, then you haven't found a valid three drive pattern. Symmetry is key to a three drive pattern. Elapsed times. So symmetry is key to a three drive pattern. So patterns should be immediately clear. Let's get that in. Was it 49? Trading the three drive. You can trade a three drive pattern in the same way as an A, B, C, D. So the same way as an A, B, C, D. Waiting for the final drive to end, then trade the reversal that should follow. Opening a buy position if the market has bottomed, or sell if it's topped. Trading the reversal that should happen. So wait, let me see. High chance of market reversal. So if you see at the beginning, then well, it hasn't reversed though, because it goes down. Oh no, it went up here. So A, B, C, D, E, F. A, B, C, D, E, F. So that one would go back up again, because that went down first. Right, and then, right, I see. So, in the same way as A, B, C, D, wait for this final drive to end, then trade the reversal that should follow. Wait for the reversal to end, then trade. Wait for the final drive to end, then trade the reversal. That should follow. The third drive should mirror the one that precedes it. So if you can identify when the market is likely to reverse and plan, you can identify when the market is likely to reverse and plan your entry accordingly. The third drive should mirror the one that precedes it. 1, 2, 1, 2, 3. So that one should be the same as that one. That one should be the same as that one. That one should be the same as that one. That one should be the same as that one. Third drive should mirror the drive which precedes it. What? How do you spell precedes? Precedes it. There we go. So you can identify when the market is likely to reverse and plan your entry accordingly. Make sure to watch for significant gaps at any point. These can be a sign that the trend is invalid. Watch for gaps. Significant gaps at any point could show that the pattern is invalid. So if you see one, wait for further confirmation that reversal is on the horizon. If one appears, wait for further confirmation. For a reversal. There's been a lot of waiting before you confirm doing something. So that's the pattern I'm seeing. So I guess don't just jump straight into buying stuff. Wait until it actually happens what you think is going to happen. If that makes sense. Yeah, so make sure that what you think is going to happen. There we go. If the pattern fails, then a strong continuation may be on the cards. Fails. Strong continuation is on the cards. If the pattern fails, a strong continuation is on the cards. Alright, cool. A 3-drive fact sheet. Type is a pattern used in any conditions, used for finding opportunities. Markets any, time frames any. Cool. Time is it? Alright, I'm gonna leave this episode here. Thank you guys for watching. In the next video we're going to cover our favourite fib. So yeah, see you then. Peace.